Welcome to Data Skeptic Time Series.
This is Data Skeptic Time Series, the podcast about how to predict the future based on historical sequential data. Episode number. If you're lucky in your time series problem, you can make some certain assumptions. Maybe you assume a constant rate of whatever you're interested in, or you assume a constant variance, or you assume it's stationary. These are nice assumptions to make because they offer up statistical techniques that work really well and have good theoretical underpinnings. However, such models don't work very well, if at all, when you violate one, two, or three of those assumptions. In this episode, I speak with Darren Shannon about the paper Extending the Heston Model to Forecast Motor Vehicle Collision Rates. This model doesn't make any of those assumptions, and we talk about how it works in practice.
My name is Darren Shannon. I'm a Quantitative Finance lecturer or associate professor in the University of Limerick, Ireland. And the research I suppose we'll be talking about today comes through our research group, the Emerging Risk Group, in the Accounting and Finance Department in the University of Limerick.
Obviously, we'll get into the specific topics of this paper, but broadly speaking, what sort of research are you interested in?
That's actually a great question because it's on the nose with what the purpose of this paper was. My background is in mathematics. That's what I did my undergraduate in. I followed that up with a master's in computational finance, so it was quite a quant-heavy course. But after that, I got funding to do my PhD in researching self-driving cars and the enhanced efficiency and safety benefits that come along with them. So that's quite distinct from maths and quantitative finance. And all throughout my PhD, I was also teaching finance, was also researching about self-driving cars, autonomous vehicles, and how to investigate road safety in general. So really this paper came about because of an attempt for me to kind of mesh the two together, to kind of try and find my academic identity in terms of whether I'm a finance person or a transportation research person. So that's what this paper came out of, applying quantitative finance research to transportation safety.
Well, historically, vehicle collision rates, people have been interested in this, I assume, since cars got to a certain critical mass. They must have been forecasting it just about as long. What have the traditional approaches been?
So there was pretty much an explosion of research around the 1960s, all throughout to the 1980s, and then it kind of caught on in the general public. So the first set of research was basically just tracking trends, using histograms, bar charts, the summary statistic things. Then around the 1990s, it led to linear regressions and some basic ARIMAs thrown inside there. And then we got pretty complex around the 2000s and the 2010s when the topic of what's called unobserved heterogeneity came into play, which is essentially how to track the unknown unknowns, the inherent randomness that's involved in one collision that may be the exact same as another collision but lead to completely different outcomes. So obviously the complexity of the models increased on top of that, led to plenty of books on the topic. So yeah, you got linear regressions, you got some logistic regressions as they developed, then some ARIMAs, then SARIMAs, then some ARIMAXs, and then some probit models, that kind of stuff. But then recently there's moving away from that because they quite often determine that there's a fixed variation structure in the collision rates, that the variations from year to year or month to month stay the same over time, but research indicates otherwise. So my latest attempt uses stochastic volatility, which doesn't assume these kind of fixed structure of variation, that collision rates, crash rates can change over time, and we have to find modeling techniques to kind of adapt to that too.
What's the, resolution at which you want to make a forecast? Is it like daily, hourly? What's the goal?
I suppose it kind of depends on the context. One of the specific reasons why I tried to tackle this kind of a topic in this paper, I use monthly data in this, and it was formulated on reading centrally released reports on the future of road safety or the outlook on road safety, and all of these government initiatives or these NGO initiatives to cut collision rates in half or road fatalities in half. And it's a fantastic initiative, but I was always thinking, where are these rates coming from? How are they defining these rates? And even if you go to the reports, the post hoc reports that kind of dissect how the progress is going and we've achieved or the standards that we set, a lot of them, although they achieve solid gains and solid benefits, a lot of the targets are not hit. So in this case, I wanted to create a paper or a model that could just track the trend over time whilst incorporating a lot of flexibility, and as a result of the parameters in the model, that could incorporate a lot of expert judgment into the model such that a more objective basis for where these safety targets are coming from. So in that sense, if we're looking long term, then I thought monthly data would suit best.
Could you elaborate more on the safety targets? It seems intuitive to me that local government would want to set and make it go down and all that kind of stuff. We acknowledge it can't be zero, but you want a low collision rate and especially low fatality rate. Do they actually have any control, or is that just a wishful metric?
Yeah, of course. So that's something I'm struggling with too. A lot of these reports tend to aim for 50% reductions over, let's say, a 10 or 15 year period. I know that's what the target is in the EU. And now we've got a more widespread target of Vision Zero, where there's zero road fatalities and zero severe injuries by 2050. And once again, they're fantastic initiatives and they're fantastic targets to have, but they can be seen as a bit blindly ambitious unless they're also justified in terms of where the targets came from. I mean, the basis of my research is just to be able to provide an objective basis upon which you can hit your benchmarks whilst also improving road safety.
Are there any trends when you look at longitudinal versions of the data? Even if we can't explain the regions just yet, or maybe you can, is there a long-term trend downwards or upwards, or what's going on in the big picture?
It depends on the jurisdiction and it depends on what you're looking at. So I actually make that point in the paper that Ireland has done a fantastic job in the last 15 years in reducing road fatalities. They've dropped by 50% in 15 years, which is fantastic. But in the meantime, the overall collision rates have increased. So there's more crashes happening than ever, but the amount of fatalities is dropping. And while that's great in terms of saving lives, it still introduces a lot of economic damage that we have to account for. And if we can reduce that in some way and keep track of it and set safety targets, then in addition to lives being saved, we can save on economic costs too.
One of the criticisms you mentioned of some other modeling techniques were that they assume a fixed structure of variation. That seems sort of like an obvious flaw in a way. There's things like weather that are seasonal in the truest sense, right? You could have 4 seasons depending on where you live. But even beyond that, there's times when it's more or less rainy in the year, which I have to believe must affect vehicle collision rates in some way. Do those fixed structures, are they ultimately going to fail in trying to account for all these variables? Or do they just kind of say it must be a uniform, unchanging process? I guess, what are the modeling techniques really doing in that regard?
Yeah, so that kind of brings me back to the point of what's called unobserved heterogeneity, in terms of the fact that the variations in the variations can change over time. So there is heterogeneity that we have to track, and that can render some models obsolete unless they're updated on a very frequent basis. So what a lot of the models do in contemporary research is to try and pull apart what the error terms are looking like what the residuals are looking like, and how can we incorporate random variability into those that can better keep track of the changing flux in collision rates over time or crash rates over time. So one of the reasons why I like the Heston model is because it's such a flexible approach in that you can incorporate this heterogeneity into your estimates and into your expert judgment if you think it's going to happen. So it provides a very flexible and a very parsimonious way of incorporating all these random variations that happen from one period to the next, while still incorporating the trends that you expect and being pretty accurate.
So my understanding is that the Heston stochastic volatility model is fairly popular in finance, that's sort of where it came from. Can you talk about why this is useful in its more traditional implementation?
So it's pretty much used to estimate what the future value of an asset will be, whether that's an option or a stock or a commodity. And we took some liberties in this paper in that the parameters in practice for the Heston model are formed on real-time data derived from options. So you find an optimal fit for how these parameters fit on real-time options. And it's done well since it was introduced around the early 90s, and it has some extensions, and it's still used quite a lot in practice. So it's still seen as one of the creme de la creme models out there. And I suppose its application in transportation safety was predicated on the fact that we saw a lot of commonalities between how stock prices or asset prices behave and how the collision rates were turning out in the data. So our approach going into it was just to see whether the Heston model could be applied well on crash rates, and let's just see how it performed. And thankfully, the mathematics backed it up, and so too did the forecasts. They were pretty accurate in the end.
Could you expand on those similarities I guess maybe in their mathematical form? It's not obvious to me that stock market data would bear any resemblance to traffic safety data.
Yeah, so looking at the mathematics of this, stock prices, if you were to plot them over time, they are essentially log normally distributed because of the assumption that they will rise over time, they will trend upwards over time, and so that there will be a big stack of low value terms, but then as it increases over time, you'll get an increasing amount or a smaller amount of larger values. So if you were to plot them, they're somewhat log normally shaped. And if you're to look at the returns on that, the percentage changes on a day-to-day on a log normal basis, then you would see that they follow a normal distribution. And when I was looking at traffic safety reports that was released by the Road Safety Authority in Ireland here, I noticed that the same trend was visible in that there was a slow drift upwards that was interspersed with what seemed to be pretty random deviations. So after plotting it, I realized that there is quite a lot of low values, but because of the trend upwards in time, there's a series of tail values that represent the latest values that have increased over the norm that was seen in the prior past. So once again, if you're to look at them on a percentage change scale, on a log normal scale, let's say, they also came out to be somewhat normally distributed, which followed the same properties as stock prices. And so that kind of gave us the first indication that maybe we could use financial models in this. There are a few different properties involved with crash rates that don't apply with stock prices, of course, in that we saw pretty quickly that crash rates are independent on a month-to-month basis, whereas stock prices follow they have a Markovian property in that people trade on the information they have, and the information they have is where the previous stock price was. So on a day-to-day basis, any stock price is measured in terms of its change from its previous price, and that's how it's determined. Whereas people in cars going about their business on a day-to-day basis aren't really worried about what the crash rate was the day before. So although they have the same statistical properties in terms of distributions, they don't have the same properties in terms of the Markov chain property. And so we incorporate that into our model too, in that we change from how the process goes for stock prices. They're typically tended to be viewed as following the Ito process, and we change that to modeling them using independent time steps rather than dependent time steps.
And can you expand a little bit on the parameters that go into the model? What are the actual dynamic variables you're looking at when doing the forecasts?
Sure. Would you like it in terms of the original Heston model or the new ones, let's say?
Maybe let's do both.
Sure. Yeah, it's a pretty involved model. It's certainly not a plug and play model. A little bit of domain expertise is required to know what's going on in the differential equation. But essentially, you start from the variance term. You understand that the variance is not fixed in itself. It's actually based on what the variance or the volatility in the markets, in the stock markets, let's say, are today and what you think they will trend to over time. So let's say it's a highly volatile day today. What do you think the markets will calm over the next month? So you can incorporate that into the first differential equation that you have, in that you have a certain volatility today, you have a long-term volatility that you think it will trend to over time. You also have another parameter that tracks how quickly you think it will trend to that long-term volatility. On top of that, you've got these random deviations in the mix of all of this that are determined by a volatility of volatility parameter. And this is where the heterogeneity comes in that you can control the rate of random variations that exist within the variation structure. So that's how the volatilities are discerned. Once that is figured out, that is brought into the asset pricing equation, which is linked through a correlation parameter. So in essence, the asset prices are linked or correlated to how the volatility is going at the moment. And on top of that, you just add that on to the expected trend that you're expecting in the parameter over time. So that's controlled by the parameter mu, which should be familiar to any finance student, which is your upward drift, or if you're looking at it pessimistically, your downward drift. So that's attached on to the current stock price. And what gets added on to that is the random variation that was figured out in the other equation. So it's a two equation model that pretty much estimates the future asset prices based on a complex mixture of random variability that is linked to the current asset price. So we flipped those 5 parameters around, which were the drift term, the current volatility term, the long-term volatility term, the mean reversion rate or the speed at which we expect the current volatility to trend towards the long-term volatility, and the volatility of volatility term, which determines how much heterogeneity we want to incorporate into the model. So we took all those and we were sitting down and thinking about how those actually apply in collision rates. So the mu term, the drift upwards, we instead expected that road safety authorities or policy drafters or policymakers would expect a downward drift in crash rates over time. That's, I suppose, what we hope to be looking for. On top of that, many of the remaining parameters kind of remain the same in terms of we have the current volatility in crash rates, but what we hope to reach in the future, we would expect or hope that the variations in the collision rates on a month-to-month basis will trend downwards over time. So those kind of remain the same, as well as the speed at which the current crash rate volatility will trend to the long-term crash volatility. And of course, we look at observable rates and look at how much variable is within the year-to-year collision rates as well as the month-to-month collision rates. And that year-to-year term would kind of represent the volatility of volatility, or how much heterogeneity there is in every yearly collision estimates.
And what's the process for fitting the parameters you need?
I mentioned earlier how in practice the parameters for the Heston model are determined based on real-time option prices. You get an optimal fit, and there's the parameters that you use, and you use that to look forward in terms of how the asset price will evolve over time. Obviously, we don't have option prices to use for the collision rate Heston model. So instead what we used was best estimates for how we expect the drift to go over time. And for that we just looked to offset the amount of new vehicles coming on the road every year. So that's how we set that term. In terms of the current volatility, we just discerned that using the monthly rates, we found the differences between the monthly rates. We then found the standard deviation of the changes in the monthly rates and then divided that by the time period. So we divided it by 12 and got a yearly estimate for what the standard deviation is. So based on that, we had 5 years of standard deviations. We looked at the log differences between year to year standard deviations, and we repeated the process to get our volatility of volatility term. Then, so the current volatility is based on what the latest standard deviation was, and long-term volatility is based on our best estimates of what we would hope it be. And once you fill in all of those terms, then there is a thing called the Feller condition, which will prevent negative volatilities from occurring or negative variances from occurring in your estimates, and that will discern what the mean reversion rate would be. So how long it will take for the current volatility to trend towards what you hope it will be in the future.
Do you have any insight into what some of the driving factors are behind that underlying volatility? Is there any thoughts on what the explainable variables are if they were measurable?
Yes, so being pretty frank, that's actually one of the key criticisms that could come in the way of this model, in that it is almost a latent representation of what's actually happening in the road in terms of the factors that drive the crash rates themselves. So it's a latent representation of driver behavior, the setup of roads, the congestion in traffic, commute patterns. We're just assuming that all of the information related to those variables are captured in the recorded data itself. So we have gotten feedback on the fact we don't incorporate the specific factors in a deterministic manner in our model. Instead, we are basically assuming that the data itself can be used to estimate future values. And I suppose that's kind of a trait that's somewhat shared by the ARIMA models too.
The following message comes from Data IQ, the platform for everyday AI. Let's face it, the potential for positive change with AI is huge. But seeing that value is hard. AI-driven growth is about organizational transformation, not just technology. And today's businesses struggle with the complexities of bringing AI innovation to fruition. That is where Data IQ comes in, infusing a culture of working with data and AI every day and at every level of the company. Whether solving for the mundane, like automating forecasting, or What is the optimal number of widgets to buy? Or understanding moonshots that push the limits of today's technology to grow your organization and innovate. That's Everyday AI. Join more than 45,000 people worldwide across banking, insurance, pharmaceuticals, manufacturing, retail, and more who are driving results with Data IQ. Visit dataiku.com to learn more. That's dataiku.com. VPLS is a managed service provider and managed security provider with a 20-year history of industry-leading customer service. VPLS's network and security operations centers can be an additional resource for your IT team or function as an outsourced IT department. They offer help desk, managed security, managed backup, and other managed IT services. They handle the IT needs of both large and growing companies and can help your team with IT needs of all sizes. They operate 24/7, 365. Who else does that? Maybe they're a good fit for after-hours support for your team. When it comes to things like cloud migration or backup and disaster recovery, you're going to need outside expert help. VPLS is a great fit for companies with existing IT staff and teams, but may have some gaps in their IT framework, which could include cybersecurity, network optimization, and more. They're great for companies without existing IT support who are looking for experts to manage their entire IT infrastructure. And they're great for companies looking for IT expertise for a specific project or issue. Visit vpls.com/GoIT to see all their offers, including a low monthly co-location rate for new customers. That's vpls.com/GoIT. Yeah, that makes sense. I'm curious if you have any thoughts, though, about what they are. I could imagine where a slow change in volatility might represent that there's a pothole that keeps getting bigger and bigger until, it's causing more damage. Or it could be, a property owner puts up a big barrier and suddenly you have this change point in the data where visibility's gone down. And we could sit here all day and make stuff up, right? It's a complex data generating process. Is it hopeless to try and account for the fact that a Mylar balloon distracted a driver on Tuesday and all these factors? Or do you think there's any value in maybe trying to extend the model with some exogenous factors like that?
Yeah, of course, that's one of the long-term views that we want to take with this model. We are looking at ways in which we can keep the level of flexibility to look outward into the future, whilst also incorporating these deterministic factors that can fully explain what's actually going on and whether you do hit a pothole, and that will cause a lot of people to get involved in accidents along that specific road. For this paper, though, we took more of an aggregate view, a long-term view in terms of tracking how rates may evolve over time if we are to incorporate, let's say, traffic safety initiatives. Let's say we close a road that is particularly dangerous and open up or encourage traffic flow on a different road that might be safer. And our estimates that we develop in this model are based on this kind of approach. And we fill in the parameters to account for these expectations of what may occur over time. Of course, we can't fully predict the future. So these are our estimates of what could happen based on if we change the parameters. So if we were to expect an increase in the level of variability in the model, let's say if we were to increase the volatility in the model, we would assume that would represent the fact that driving behaviors have become worse over time. Even if the level of safety on the roads hasn't changed, driving behavior might become more aggressive, or the increased level of cars on the road might increase traffic congestion, which will have a knock-on effect on the actual rate that is observed in the end. So we incorporate that into our assumptions. An increase in volatility is largely related to increased or more aggressive driving behavior or increased traffic on the road. Whereas on the other hand, if we assume that there'll be a drop in variability, we're expecting that to come about because of the increased proliferation or presence of self-driving cars on the road and the connectivity and communication technologies that will enable them to act in a more efficient and safe manner. So, of course, if there's a lot of platooning going on, a lot of cars that can interact with each other in order to determine an optimal path so they won't crash into each other, then you would expect a lot more cars to follow the same patterns, and so that would drop the level of variance in the crash rates that are observed because most of the cars are acting the same way, whereas currently it's a bit haphazard because it depends on the person.
What are the opportunities for policymakers and organizations, governments to take advantage of your work in its current state? Can we start rolling things out, saving lives, reducing costs, stuff like that?
At the moment, it was positioned as a conceptual paper that turned out to work really well in a test data environment. So at the moment, I don't think it's a plug and play model that can be introduced. Of course, it can be used if someone sits down and gets to know the parameters. However, we are working on automating the parameters so that it can be much easier to just plug in and enter your estimates of your assumptions of what might occur in the future, and it will produce a trend or an estimate for what may happen over a 5-year or 10-year horizon. That will be based on your expert assumption, let's say. We would envision that this will help policymakers create a more objective basis for setting safety targets in the future. And we would hope to help any organizations that want to get involved with that, whether that be on a continental level like the European Commission or on a national level like I have here with the Road Safety Authority. If they want to set targets that are based primarily on targets that can be backed up using a model, then I'd be glad to get involved with them and help them out with it. So we will be doing further research to kind of make the process a bit simpler and a bit more interpretable, let's say.
Did you have any opportunity to compare your results to the results from similar models that have already published in the literature?
Yeah, so in the paper, we actually measured the performance of this Heston model at the behest of my co-author, Greg Fountas, to measure it firstly against the long recognized and the long respected ARIMA model, or in this case SARIMA, because there was seasonality involved in the estimates. So that was on the purely statistical side of things, but we also wanted to see how it worked against other financial models. And for that, we found that the Vasicek model was used in transportation literature too. So we compared our estimates against their estimates, and we found that there was a pretty sizable improvement on the parameters or on the results that they produced. Our mean average percentage errors was around 5% compared to those models, which was around 7 and 7.5%. So it may not seem like much, but when you're looking at collision rates on this kind of a scale, that was a pretty sizable increase.
And with that in mind, are you interested in pushing this further? Do you think the model you guys have is pretty much robust and a balance of complexity and simplicity for fitting the data? Or are there other techniques, maybe some deep learning approaches that might push the accuracy higher?
Yes, so this is something I want to explore further myself. What you're saying about balancing complexity and simplicity is quite important to us, that any adjustments that we want to make have to bear in mind that we already have 5 or 6 parameters in there already, and we don't want to add too much in there that would be subject to quite a lot of subjectivity, and that could introduce room for exploitation that we hope to avoid. So we would look to be bringing in exogenous variables in. But at the same time, one thing that I didn't do in the paper that looking back I wish I had, and I will do this quite soon in a follow-up paper, let's say, is the consideration of neural networks on it. Looking back on it, I see as a bit of a flaw. However, it may not have done well given the limited data constraints, so I'm looking forward to see what it produces. I'm always looking for ways to make sure that it is as robust as possible. I don't want to shy away from seeing whether this is a poor model when we actually find the right model to fit. So we will be testing against neural networks, seeing how it performs and finding ways to improve it.
Well, at the time you guys did the work, the data set that was available spanned 2014 to 2018, when there was a major change point event in the pandemic that's happened since then. I don't know if that data has been released yet or if you've had a chance to look at it, but either way, could you speculate or state how will your model adapt to this sort of unpredictable dynamic event?
So yeah, that is something I look forward to. I've presented my research a couple of times now, and every time I say I cannot wait for the data to be released just to see how it performed. It won't be on track with the best line estimate, of course, because there was a 30% drop in crash rates. However, I would be interested to see whether it fell within the confidence interval bounds that were included in the model. It will also be interesting to see if the crash rates return to the pre-pandemic levels. And we will investigate whether there was structural breaks introduced by the pandemic and whether we will have to adjust to a new norm of how crash rates are determined. I did notice that there was an increase in aggressive and risky driving during the pandemic, which is pretty interesting. So let's see if that stays when traffic congestion gets back to normal.
Is that an anecdotal observation, or is there a way you can quantify that?
We moved away from the Irish data and we looked at data from the USA, and we saw that there was a 30% increase in drink driving cases throughout 2020 compared to 2019.
Wow, that seems like I would imagine that's historically quite a shift compared to maybe the last 10 or 20 years. There can't be that much variance in drunk driving year to year.
Yes, you would hope it would return to normal. I'm not too certain about the historical dynamics in terms of the drink driving rates. It has been trending down over time, and this does represent a spike upwards. So let's hope it returns back to normal and continues its trend downwards.
Well, there's one area I hope we can zoom in on to wind up. I kind of skipped over as we were talking through some of the parameters of the model. I think we touched on the collision rate reduction targets and the variance in collision rates and how these are built in. But what about switching parameters? Could you describe those and maybe comment on what mechanism they provide in the model? Why are those useful for these sorts of forecasts?
Yeah, so there was the three key changes I introduced to the model. One was the seasonality in the crash rates that were evident. The other was the fact that we didn't want to follow stock prices in terms of the Markov chain property. We wanted to view them as independent time steps. But yeah, the third one I think is the most significant one. And this is the key addition to the model I think will benefit policymakers the most in terms of incorporating the influence that external road safety initiatives or external events can have on the model. And what we did was we assumed that over the next 25 years, there will be a series of events that serve to reduce the crash rates at an accelerated pace than before. So our idea behind this was the introduction of semi-autonomous vehicles or connected autonomous vehicles or self-driving cars that are fully in tune with the network, this connected, cooperative and automated mobility, that their introduction will serve to reduce crash rates, but that their effects will only last for a certain amount of time before crash rates return to their normal trend that we would hope to be going downwards. And the reason that we introduced that as a specific term in itself is that we thought that that was a random process in itself. There might be, let's say, an EU directive that will, somewhere down the line, that will rule out the use of conventional vehicles. And we've already observed stuff like that in the UK, let's say. They are banning the sale of diesel cars from 2030. And I think in the US as well, 99% of vehicles that are manufactured from 2020 have to incorporate some level of an automated driving assistance system that will serve to reduce crash rates. So we are seeing a bit of these observations, and we wanted to incorporate these into our estimates too. And the reason we chose 3 years, of course, is in keeping with the risk homeostasis or the risk offset theory, which basically posits that as there's an absolute level of risk reduction on the road, drivers will tailor their level of risk behavior upwards. And so any envisioned safety benefits are at least somewhat offset by the fact that as cars become safer, drivers become somewhat riskier.
That makes intuitive sense to me. Are there ways in which you have a corollary in the data you can point to and say that this is the clear relationship where people have started trending in that direction?
So once again, this is the process I usually follow with these models in terms of I look at a problem, I eyeball the problem, and then I kind of look at what kind of model would best suit this problem and how can we incorporate any assumptions into it using on a mathematical basis. And what I arrived at was the Gumpert's distribution, which is often used to form a mortality curve. But if you look at its probability density function, it kind of looks like a truncated normal distribution. And when I was looking at it, I was thinking that it might be a good representation of how the future of road safety initiatives, the introduction of these kind of new technologies onto the road might play out, in terms of that there is a non-zero chance that these safety initiatives happen today. However, in the near future, we would expect that to be happening at a higher rate. So we would expect a higher probability that these road safety initiatives are announced in 5 or 10 or 15 years. And that actually reached a peak around 2040, 2045, which is what the current assumptions are in the literature for fully self-driving cars enabled road networks. And so we would expect the largest rate of collision rate reduction happen around that time period. So we basically modeled a probability density function that will account for this factor, and then after that it will kind of taper off over time because most of the benefits will have been realized at that point. And so to incorporate that into the Heston model, to get this on an objective data point by data point scale, I just plotted the probability density function of the Gumpert's distribution, and then I just did a random binary distribution draw. And if each of the data points that were drawn from the binary distribution fell within the threshold that was defined by this Gumpert's distribution, then we'll see that as a hit. And of course, because the probability of that happening in any one month is incredibly low, then you might only get 7 or 8 hits over the next 40-year period, which would indicate that there's 7 or 8 3-year periods along the way in which you'll see an accelerated rate of reduction. So we call that our Gumpert's shock.
Well, maybe to wind up, I'm hoping I can ask you to speculate a bit. It seems to me that a city of a sufficient size, not every one, but a major metropolitan area, they must already be doing some things in computational transportation systems, and their leadership certainly must be thinking about what it will mean to have a city with autonomous vehicles in the future and how they'll apply policy there. What's your vision for the types of roles that should exist inside a city? Maybe they're employees or contractors, not necessarily that, but who are the types of professionals that should be informing how governments make decisions around this sort of thing in the future?
Yeah, so key obviously is increasing traffic efficiency, improving road safety, and enhancing the level of inclusivity and accessibility for any groups in society who may not have access to transportation systems themselves or spend too much money on it. And there are a few key stakeholders, let's say, that should be involved in that conversation. Software engineers, of course, they will need to enable the use of these automated vehicles and code up the functionalities, code up the connectivity systems with which these cars can connect with each other and communicate with infrastructure that's built into the road or built in the cloud and through satellites. So software engineers play a massive role. Civil engineers obviously play a massive role in laying out this infrastructure. But we also see a big role being played by telecom networks as well, who can actually provide all these services, and the infrastructure providers who will actually lay these services down. So all of those will gather together to kind of take us to the next level of self-driving car capabilities. We're kind of moving away from the perspective that self-driving cars alone can introduce all of these benefits, because they're kind of driving blind. They have to estimate everything around them. However, in the next generation, if we can lay down the infrastructure that will be able to let them see blind spots ahead, or that will enable cars to communicate with one another, well, then they don't need to estimate or try and figure out what the other car will be doing. They will be able to have access to that information already. So yeah, what I see as being the next generation of safety in cities is the installation of appropriate infrastructure that will enable cars to communicate with one another and communicate with those around them, whilst also incorporating the requirements of pedestrians and cyclists on the road. So we all have to cohabit these cities together, and so everyone needs to be incorporated into this.
Yeah, very exciting vision. I hope to get to watch unfold myself.
Yeah, let's hope it happens soon.
Well, Darren, where can people learn more about your work online?
You can see my Twitter at Darren Shannon 74. You can also follow our research group at Emerging Risk Group. We're based in the University of Limerick, and we tackle all kinds of emerging risks, like we've been talking about autonomous vehicle risks, but we also do some nanomaterial risk or cybersecurity risk as well. So we tackle a wide range. And we're also in partnership with LERO, the Irish Software Research Centre, and Science Foundation Ireland, who kindly provide us support for tackling all of these issues related to autonomous vehicles that kind of allowed this paper to happen in the first place.
Well, exciting stuff. We'll have links to all that in the show notes for listeners who want to follow up. Darren, thanks again for taking the time to share your work.
Thank you very much, Kyle. It was a pleasure chatting to you.
That concludes another installment of Data Skeptic Time Series. Our guest today, Darren Shannon. Thanks to our sponsors, Data IQ and BPLS. Myself, Claudia Armbruster, as associate producer. Vanessa Bly, guest coordinator. And our host, Kyle Polich.